Hey everyone, I'm Daniel Snyder from Seeking Alpha. Today we are joined by Lyn Alden, one of the contributors for Stockwaves, a marketplace service found here on Seeking Alpha. Lyn, how are you doing today?
Good, how are you?
Doing well. I can't thank you enough for coming on to share your knowledge of the macro environment of the market. Today we're covering the recap of Jackson Hole, Amazon and Walmart in the world of crypto, reduction of margin, is Apple still worth its evaluation, and is gold still the flight to safety asset? So let's dive into Jackson Hole, which happened at the end of August. Everyone had their eyes on Powell's comments to analyze whether he was still dovish or ready to move on tapering and interest rates. What did you pick up from the meeting?
Well, so prior to the meeting, we were seeing early signs that they were planning on, laying the foundations to get ready for tapering their asset purchases. And so, for example, they put in two standing repo facilities, even though at the moment there's no demand for repo. All the demand is for reverse repos, but they're still looking forward and putting those repo facilities in, which could prevent similar things to what happened back in 2019 when they were doing quantitative tightening. And so they're getting the foundation in place. And also, I mean, all this reverse repo activity kind of shows that there's too much, ironically, too much liquidity in the system, and it's spilling back over into the Fed anyway. And so they're getting all these signs that it's getting ready near time to start discussing tapering. And so the big question that a lot of people had going into Jackson Hole was, would Powell announce a specific date for tapering or not? And my base case is that he probably would not, especially with the whole Delta variant happening. The Jackson Hole event was moved virtual. And so far, that's pretty much what we saw, where they kind of did a good cop, bad cop routine, where a number of Fed officials came out pretty hawkish. Some of them had specific tapering dates that they'd like to see, generally starting, maybe later this year and then ending in the first half of next year. Whereas Powell himself came out a little bit on the dovish side, didn't yet commit to any tapering plan. Discussed how interest rates are very disconnected from tapering, right? So they just because they're planning on tapering doesn't mean they're planning on raising rates anytime soon. And also kind of emphasize that if you look at broader employment measures, there's still pretty high levels of overall unemployment, low labor participation rate, and so he has a pretty high threshold for especially for raising rates, but even still remaining non-committal on tapering.
I'm glad you bring that up because it seems like the focus has gone from inflation to unemployment. Would you agree that that's what you're looking for now? Are you watching the monthly job reports going forward? And how should investors be preparing for what's to come?
Yes, I think Powell kind of set the stage last year at Jackson Hole by kind of pointing out their shifting emphasis. So for the past 40 years or so, ever since Volcker raised rates and turned us from a structurally inflation to a disinflation period for 40 years, they've been kind of emphasizing inflation over unemployment, where they have two mandates that they balance, and they've been treating a 2% inflation target, especially in the past decade or so, more like a ceiling. Whereas going forward, they want to emphasize that unemployment is in their view probably more important, especially when you go down into not just one employment figure, but employment among different demographics, employment among different income levels, wider measures of unemployment, like underemployment, marginal employment, things like that, and that they're willing to let inflation run hot for periods of time. In their view, I also think that if you take a step back and look at history, where we are in the long-term debt cycle, many countries don't really have much of a choice other than to run kind of persistently negative real rates for their at least their short-term treasuries, even their long-term treasuries. And that's the part that they can't really say out loud, too much. So instead, it's focusing on that unemployment figure. I think kind of emphasizing that more so than the inflation figure.
Right. So at this point in time, we're obviously not looking to go negative on rates like other countries, but rather look at unemployment to get back to where it was pre-pandemic. Powell came out months ago and said that we weren't going to stop until we get pretty much back down to 3.5% unemployment rate. But is that actually going to happen? Are we going to get close and then Powell will change his mind? Do you have any thoughts on that?
So that still probably has a little while ahead of us. It took quite a bit after the previous crisis, and this might happen quicker, but it still will take some time. And to be clear, that was for the interest rate, so they can start tapering their rate of asset purchases before then. But he kind of insisted they would not raise rates until we've hit, in his view, maximum employment. And so, right now they're buying $120 billion a month in assets. And it's important to keep in mind if they reduce that to 80 billion or 40 billion, they're still doing quantitative easing. They're still hyper dovish. They're just slightly less dovish than they are now. And so it's different than quantitative tightening or raising rates. So they're kind of discussing how dovish they want to be, whether or not rather than saying that they want to switch to hawkish.
Yeah, everything is up and down and sideways and consolidating, and now we're seeing that Amazon and Walmart are now entering into the crypto space with their new job openings for the head of crypto. I know you cover this space quite a bit, so what does this mean for the crypto space?
Well, so it's still early times. They haven't formally announced what that means. They're clearly, I don't think they fully know what that means yet. I think that's part of the position is that they want to have more people on board that are researching the space, that are understanding the space, and that are making recommendations to top executives. And so, one way or another, we're clearly headed towards a digital future in terms of money. And so, you have a variety of private assets like, say, Bitcoin or Ethereum. Then you have private stable coins like USDC, for example, Circle. Those more regulated types of coins. We've seen that Facebook has shown an interest in getting into the stablecoin market. So earlier it was Libra, then they faced some regulatory pushback. They kind of resurrected that as DM. We'll see where that goes. But clearly, stablecoin technology is very, very useful. And so that could have a large role to play in future payments. We also see various central banks around the world have kind of shifted towards researching central bank digital currencies. Some of them, like China, are far ahead of the curve. Other ones, like the Federal Reserve, are significantly far behind, and so they might be more willing to say partner with private, stablecoin issues and things like that. And so I think these basically one way or another any companies need to start figuring out what is the future of money going to look like. Do they want to accept, say, Bitcoin payments, including over Lightning, for example, which are very efficient payment mechanisms? Do they want to accept stable coins? What do they want to know about central bank digital currencies? And so, any large company really should, at this point, I think, have some crypto experts on staff so that executives know what's going on, or at least if they're smaller companies, to at least consult with firms that are really on top of the industry.
But there are so many different types of cryptocurrency. So you're saying that they're trying to figure out should they accept all methods or all coins, or is this more the technology perhaps for moving products around warehouses? I think a lot of investors are stuck here trying to figure this out. Is there perhaps some other method that they are looking at that we're not thinking about right now?
Or they can also consider, blockchain technology itself. Now, the Amazon already has kind of things like that. We have kind of a mostly centralized blockchain-like database where you can track changes. And so, you know, kind of the whole point of a blockchain is that it's a really inefficient database that happens to be decentralized. So you pay the price of efficiency in order to have it decentralized and therefore less vulnerable to corruption or other risks. And so they can explore what that means for them, whether or not they want to get into the smart contract space. It could be very useful for insurance companies, as an example. Basically, writing things through code rather than human decision. And so there's a bunch of different factors they can look into. And then as you get larger and larger, as the space gets bigger and bigger, there are more people that do want to pay in cryptos, and it could literally again just be stable coins where you're still accepting dollars, but just in a different form. And so they have a lot of work to do, I think, to understand the full kind of spectrum of ways that space is relevant to them in their business because they don't want to fall behind.
So will these companies have to put this cryptocurrency on their balance sheets? I mean, will we see the Tesla effect with these two companies to whereas the price of the crypto rises and falls, so will their line items on their quarterly reports?
So it's certainly one of the options. I think if we were to see that, we'd probably see it more like say Square and Tesla, where they put a small percentage of their cash into that. I wouldn't be surprised to see it out of Facebook, for example. I think it'd be pretty rare, at least for a while, to see more companies do the MicroStrategy approach, where they put their entire balance sheet into Bitcoin. But certainly, companies with large cash positions, cash and T-bills, they're finding themselves, inflation is higher than the interest rates that they're getting. And that environment could persist for quite a while. So it used to be that having a large cash position was an asset, but it's increasingly a liability, a melting ice cube. And so companies have different options they can do. Obviously, they can invest, they can do acquisitions, but it's not always the right environment for that or the right business decision. You don't want to do acquisitions that are maybe not the best one just because you feel like you need to do something with the cash. You want to make sure you do have the right valuation for a right strategic region. Companies can buy back their shares, but then they run into the issue that, say, the airlines faced during the pandemic, where they had done tens of billions of dollars of buybacks, and then found themselves very vulnerable to a disruption in their industry, and so they basically decapitalized the business. And so you don't want to be caught vulnerable there either. And so yes, one of the things that they could do longer term is have part of an asset, part of a balance sheet in something like Bitcoin, where they're basically holding kind of an anti-inflationary asset, on the side that can, potentially appreciate in price. Now, currently, there's still very kind of complex accounting issues with that. They basically have to report losses, but then they can't really report gains associated with it. There are people that can follow that accounting, much more closely than I do. So there's still kind of work to be done in the industry. But that's kind of the going back to the point. Whereas I think they're exploring initially what they want to do. Do they want to accept it as payments? Do they want to put it on their balance sheet? Are there any other aspects of, say, smart contracts or things they might be able to use for their benefit? Certainly, you could see companies like Disney get into the NFT space. I mean, there's large kind of areas for them to explore in this rapidly growing ecosystem.
Right. We're talking a lot of confusion, a lot of volatility, a lot of innovation, a lot of stuff moving in all the different parts, which leads us greatly into our next topic, the leverage on trade. Greatly caused by volatility and chasing alpha, inflation has been rising, which means our dollars don't go as far as they did last year. The stock market is already up 20% this year, and it's at an all-time high almost all the time now. Portfolio managers have to find their way to continue to beat the market, and a lot of firms, hedge funds, etc., have taken a lot of margin on in order to ride the wave higher. But now we have reports that we're seeing a reduction in margin borrowing. And from what I understand, historically, this translates to a bearish signal. So I was wondering, can you break this down as to what you're seeing and what you think about it?
So one, we do see that equity valuations are pretty high across the board, but not evenly though. We still see value stocks out there with very reasonable valuations, but we also see, especially in the tech sector, very, very high valuations that require high expectations in order to justify themselves. At the same time, we see, households have record high equity allocations. And some of that simply because, the equity is appreciated in price, but it's also because they look at their cash and bonds that are yielding below the inflation rate, and they say, well, I got to own some equities. And so, they're kind of piled pretty heavy into that equity side of the portfolio. We've also, of course, we had the meme stock phenomenon, the trading phenomenon. That's, some extent that's also spilled over into crypto, obviously. And so there has been a lot of kind of risk-taking behavior, as you've seen, the Federal Reserve be as dovish as they have been. And as you see interest rates super low, you have all these issues. So now that the Federal Reserve is talking about the possibility of tapering, now that valuations are this high, I think that there are a number of investors out there that are concerned about risk, right? So obviously in recent months, we've had the Delta variant kind of on the headlines for a while. It's been hitting Southeast Asia for a while in particular, so it's been slowing down that growth engine. It's also been hitting China, and China is in the middle of a contracting credit cycle as well, which a lot of charts show that with a multi-month lag after China goes through kind of a credit contraction, usually you have global PMIs and other kind of measures of acceleration kind of roll over as well. And so I would say a lot of economic indicators look like they're decelerating, meaning that they're still most of them are still growing, but at a slower pace than they were in a year-over-year basis. Some of them are outright contracting, like retail spending. Fiscal stimulus is kind of in the rear view mirror now, right? So there were these multiple rounds of stimulus checks and extra unemployment benefits, and those are behind us, or in some cases still rolling off. And so there's kind of fewer reasons to be optimistic. Now we still could get another leg up, for example, but it's basically that the market has already squeezed a lot of juice out of this run. As you point out, I mean, we made tons of new highs this year. If I remember correctly, I think we've gone like 10 months without a 5% pullback, which is a very long stretch of time. And so there is, I think, some buyer exhaustion out there. And so when you do see that margin go down, historically, that sometimes it's been the beginning of a very major decline, like in 2000 or 2007, for example. Other times it can trigger easily a 10% correction or more, as some steam is let out of the market and some of the valuations reset themselves. So it's hard to, you have to be a trader to really kind of capitalize on those movements. But I do think that from a long-term investor standpoint, this is certainly an environment where you want to be very, very careful with the amount of money, the valuations you pay for companies you like.
Now, that's a very perfect point you brought up with tech and valuation. So I have to ask you, Apple, right now, almost everyone seems to be invested in it in one way or another. Not only that, but it's hitting new all-time highs. So is the valuation justifiable at this point? Like, we know they have the new product launch coming up, or has it hit its peak frothiness like some other areas in the market?
So Apple has outperformed my expectations fundamentally and in terms of price. But going forward, I don't view it as the best risk reward ratio out there. One hand shows that we pretty much have hit peak cell phone, meaning that the number of new smartphones sold per year has probably peaked. It's kind of reached saturation as a technology. Of course, there'll still be people in emerging markets that are still getting it, right? I mean, I think the saturation is something like 4 billion people worldwide with a smartphone at this point, so there's still room to go. But overall, we pretty much reached market saturation. And so for Apple, the biggest question is whether or not they can continue monetizing their ecosystem of services, right? So that's kind of what separates, say, when you look back at history, usually consumer electronics companies don't have super long lifetimes at the top because there's always a new competitor that comes along and does things a little bit better. But what we've seen from these tech titans like Apple is they build a whole ecosystem, which gives them a wider economic moat in the Buffett sense, right? And so obviously Buffett also is a big bull on Apple historically, and so that's somewhat different than just how many phones they sell. It's how much they can get out of ongoing usage of that phone and that overall ecosystem. So I still think they'll be a successful company, but I think that there's certainly I think better areas out there to deploy capital than sticking it in Apple. They're also, of course, they're vulnerable to supply chain disruptions. Maybe more separation between China and the United States, and even some of the other FANGs, in my opinion, are potentially better risk reward opportunities than Apple itself. Let alone companies that are maybe mid caps and that have, say, either faster growing potential or deeper value potential.
But with Apple, do you think it has to release a new line of products for it to go higher than where it is now? Or should we be tracking the services side of what their business does now? What do investors need to anticipate for Apple at this point?
Yeah, so I think the service side is the key thing to watch. That's kind of the main thing going forward. Another thing that's worth making note of is the leverage. And so when you look at the big fangs, I like to describe them as like a rocket ship going, into orbit, and they kind of like they release their big like boosters first, and then they continue on with another set of boosters. And so with some of the companies like Apple, they've already released the boosters, meaning that they grew a ton, they got a ton of money in the balance sheet, and then they started doing financial engineering, which is like the second stage where they say, okay, we have so much cash now, let's start buying back our shares. Let's issue debt to buy back our shares. And so a company like Apple has a ton of cash and a ton of debt. So they don't have this, they're not like, heavily tilted towards cash anymore. They've already kind of deployed that extra round of kind of per share acceleration. Whereas if you look at a company like Facebook, they haven't even gotten to that point yet. They still have tons of cash, no debt, haven't turned into this like dividend buyback machine that they could become. Same for Amazon, for example. And so I think that even within the fangs, there are companies that still have another lever to pull for additional growth. Whereas Apple, I think, has already pulled quite a number of its levers. That doesn't mean it can't grind higher from here, but it is much harder to move the needle. And it's not like they have a ton left in their war chest. At least that's the way it seems. So I think that looking at maybe the other fangs that have not really turned to financial engineering yet is one method investors can do. They can also look at, say, mid cap, growth stocks, or I think there are a ton of attractive value stocks out there as well that might provide overall better risk return than Apple.
Now, I want to pivot real quick to squeeze in one more thing before we have to let you run. We've been talking a lot about inflation, froth in the market, markets at all-time highs, and cryptocurrencies, which you cover amongst many other things within the Stockwaves marketplace service here on Seek and Alpha. But gold was historically the flight to safety in a bear market. And who knows when we have the next bear market, right? It's the one thing everyone is trying to figure out. We're even looking for a 5% pullback at this point with how the market has been behaving. But when the eventual bear market does happen, is gold still the flight to safety, or perhaps is it now cryptocurrencies? Or is there somewhere else where people might fly for safety and stick their investments with interest rates being so low?
So I think if you were to have a bear market in equities, I do think that gold would probably outperform equities. Whether or not gold would do very, very well in absolute terms, I think is an open question. The longer term issue is that, I do think that the crypto market has become large enough to take some demand from gold. So when you look at adoption, statistics, for example, it's getting to the point in the United States where about as many people report owning some Bitcoin as gold, and especially that skews younger, obviously, whereas gold investors tend to skew somewhat older. And so when you look at the size of the gold market, I mean, estimates from the World Gold Council, if you look at how much above ground gold they think there is, and you multiply it by the price, you get something around $12 trillion. Obviously, that fluctuates based on what the prevailing price of gold is, but that's roughly the order of magnitude. But then when you factor out, say, central bank demand or certain types of jewelry, if you look at, say, coins, bars, ETFs, things like that, you're looking at maybe $5 trillion asset. And so the fact that the crypto market has reached about 2 trillion is pretty interesting. It's basically it's getting in the ballpark, at least, where it's taking, I think, some meaningful demand away from gold, or at least taking the edge off. And I personally know a lot of people that say that they, if it wasn't for, say, Bitcoin, they would have bought gold instead over the past several years. And so I think around the margin, it's kind of, you can describe it as splintering demand, where kind of you had gold, Bitcoin came along and kind of maybe took some of the demand that might have otherwise gone to gold. Then you have other cryptos come around, and especially during bull markets in the crypto space, they tend to take some market share from Bitcoin even. And so money just kind of diffuses. It's like a going through a prism. It just kind of diffuses into multiple different things, and that can kind of take the edge off, especially some of those larger ones. But I do think that if you were to get a pretty significant risk off bear market period, especially if you have one that's driven, somewhat stagflationary. So gold historically follows real interest rates pretty closely. In recent months, that correlation has been a little bit weaker than normal, but over like a 50-year period, it's been a pretty strong correlation with inverse correlation with real rates. And so when inflation's higher than the 10-year Treasury yield, gold tends to do reasonably well. And so if you were to get, say, decelerating growth, economic growth, at the same time as you have inflation still being sticky and high, which compresses business margins, and causes kind of issues throughout the economy, that should be a pretty good environment for gold. And especially at a time where sentiment's pretty low right now, a lot of people are asking the question, as gold kind of lost its luster. Ironically, that tends to be the time where, probably gold's going to do reasonably well. So I wouldn't count gold out yet, even though I do think that cryptos are eating into its market share.
Well, thank you so much for your time today, Lyn. We'll let you go here. And just a reminder for everyone watching that if you want to read more of Lyn's research, check out Stockwaves on Seeking Alpha or Lyn's author profile, where she is always releasing new articles with in-depth fundamental research. And thank you again, Lyn.
Thank you.
Yep, we'll see you next time.